Ticker symbol PAYC is down around 50% for the past year, and today we'll be looking at a clear market leader with extremely good pricing power, and why TipRanks actually ranked this stock a 2 for underperformed based on a hold for analyst consensus, a decreased activity from hedge funds, and insider overall transactions of selling shares. So today we'll be looking at Paycom Software, a human capital management software company. In their annual report, they say that they are the leading provider of a comprehensive, cloud-based human capital management solution delivered as a software as a service. So in English, this basically means that it provides functionality and data analytics to any business that actually needs to manage the complete employment lifecycle. That means that they help companies in the different human capital management functions, such as acquiring talent, controlling time and labor, payroll, and even talent management. Now, we usually don't think about this and we assume that it doesn't take any time to do, but these are functions that human resources actually takes care of that take a lot of time and are pretty complicated to actually get going. Now, Paycom helps these companies by providing a software and a single platform which is connected to the cloud to help human resources actually take care of all these functions extremely quickly in a much simpler fashion. And now one great thing about this company is that it has close to 37,000 clients and none of them actually constituted more than 0.5% of their revenues in 2023. Now this is extremely solid because it basically means that they are not dependent on a single client at all. In many small cap companies, you can have the issue of like 30% of the revenues coming from, for example, Amazon. And if their contract with Amazon doesn't go too well, then this can have a huge impact on their sales. And the favorite fact I have from this company is that they have had an annual revenue retention rate of 90% and 91% for 2023 and 2022 respectively. This basically means that in 2023, 90% of their revenue came from the same clients that they had in 2022. Meaning that they're providing excellent service because the majority of their customers are actually repeat clients. And now their financial analysis is extremely solid, with their return on capital employed being 11%, them having an interest coverage ratio of 230 times, meaning that they will not have to worry about debt in the short term, and they have a very good cash conversion of 108%. Then they have a profit margin of 74% and a very nice operating margin of 27%, which is way higher than the 15% threshold that we usually set. And when we look at their financial analysis, this company has been growing revenues, gross profit, and net income every single quarter for the past 3 years. Now, as we can see, their net income has actually surged by 52% year over year, and this includes a rise in net margin, which is now sitting at above 25%. So extremely solid growth from Paycom. And we're looking at their efficiency ratios. Of course, they're following the same trends, with the one that we generally want to look at, return on invested capital, which is now sitting at around 50%. Very good for a company like Paycom. Now, when we look at their financial position, although this is a company that actually likes to have some leverage in order to speed up their growth, they're not over leveraged and they're keeping this very balanced. As we can see, their total assets are ahead of their total liabilities, which gives them a pretty solid current ratio. And on the right, we can see that their debt is lower than their equity, although I'm not sure how reliable the info to the right is, because we can see that the info actually differs from the graph to the left to the graph to the right. However, they are still in a very good financial position. And now in terms of fundamental analysis, I'm excited to say that this company actually met the 8 criteria. They got a perfect score, starting with having low liability risk. As we have seen, they have a pretty high interest coverage ratio. Adding to this, they have a very solid balance sheet as they're able to cover all their short-term liabilities with only their current assets, which is pretty solid. And they have insanely consistent cash flows. Of course, as we said previously, they have 90% retention rate, which allows them to have extremely consistent revenues, which allows them to have extremely consistent cash flow generation. And they use this cash flow extremely responsible as they're paying an annual dividend. They started paying it last year, I believe, and they're conducting share buybacks in order to return all that cash flow back to the investor. Then, as we have spoken about, this company has insane pricing power because once a company has chosen their human capital management software, it's extremely difficult for them to actually change. They would have to find an extremely better software to use, or the company that they're currently using would have to actually underdeliver from their promises, which it currently is not happening. Now, this company, of course, has growing free cash flow, which is derived by their fast revenue growth. And finally, of course, they have an existing moat and a huge competitive advantage as they have one of the best solutions in the market right now, which is an online database in the cloud, one single software which can be accessed remotely and always provides live data. And of course, the moat comes in the way that we've spoken about, that it's very difficult to actually change from software to software. It's actually kind of expensive and it's a process that takes time. So Paycom is in the perfect spot from the fundamental analysis. Now here's the dividend history of the company. It's not much, but they actually started paying a dividend earlier this year, where they currently yield 1.03% and they have a very solid payout ratio of 18%. So this is pretty positive, but there's not sufficient data for us to evaluate the company based on this dividend. And now this is where Paycom actually gets extremely interesting. Now they're sitting at a very low PE ratio in comparison to its historic valuation. As you can see, their PE ratio is right now trading at around 17-18 times, where their average in the past 4 years has actually been at around 70 PE ratio, mainly attributed to their high earnings per share growth. However, as we can see, in the last quarter, their earnings per share actually did not grow because in March 2024, they grew exponentially. When we look at the free cash flow yield, they're yielding a 3.46%, which is higher than the 3% long-term inflation rate, also suggesting that this company is extremely underrated. And the fact is that this company actually got to these levels basically because they're having a lot of shifts in their CEOs and their C-suite level, with their co-CEO actually resigning a couple of days ago and 3 new C-suite members being included. So we'll have to see how that goes because that generates a lot of uncertainty behind this company. And now the main risks and possible challenges that I do see for Paycom are, first of all, competitors or the worsening competitive landscape because of AI and all the other technologies that are developing. This poses a threat to all human capital software firms as they will have to innovate more than ever to keep ahead of the game and maintain their competitive advantages. And finally, the performance and not meeting performance objectives. I'll give this a 50% mainly because of their huge shifts in C-suite members. They added 3 new ones and their co-CEO actually resigned. So we'll have to see what his reasons were for resigning and where the C-suite members would actually steer the company from the position that they're in right now. So before we move on to the investment conclusion, please remember that I'm not a financial advisor and this is not financial advice, so please do your own research about the company. However, I do believe that this company has one of the strongest competitive advantages there is. It provides consistent cash flows which are very predictable and extremely resilient, and they have an okay to high return on capital employed, meaning that they know how to create value for the investor. So I believe that this is a good company which will probably generate high returns, especially at these levels. However, I do believe that it has high uncertainty at the moment because of the C-suite, and I will wait until the next earnings report to actually see their comments on the firm. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there's a link in bio for a free stock if you join Trade Republic.